I hope everything comes out all right, Gary.
I appreciate that. All right, on page 15.
I thought you were wiggling your nose to like you wish to for
Yeah.
the school year to be over with.
Yeah, for the semester to be done. Yeah, for your car to be complete and ready to go.
Tomorrow, transmission in.
Nice, good. Well, be careful. They're heavy.
Yeah, I end up replacing the starter and the flywheel because they had a couple of teeth that weren't perfect, and it's like I'm not putting this all back together without changing them.
Exactly. It's do it while it's easy.
Yep.
Okay, S corps. Yesterday we did an 1120 form, which is a regular what they call a C corporation. C as in cat, and that's referring to the portion of the IRS code that deals with corporations. It's under Section C. That's why they call subchapter S corporations subchapter S corporations, because that's where you find it in the corporate section of the IRS code, is in subchapter S. So anyway, that's how it's named. Now, S corporations have been around quite a while. The IRS hates them, but there's really no way to put the genie back in the bottle on these. I really like this entity type. There's a lot of flexibility. It's not hard to do. We can control our tax expense reasonably well. There are some tax practitioners who don't like them. I'm not sure why. But it is what it is. Anyway, page 11-15. There's 4 points here that talk about what you have to have in order for an S corp to stick. It has to be a domestic corporation. You can't have this corporation anywhere but in the United States. You have to have 100 or fewer shareholders. This is a much larger number than they started out with. They could be individuals, estates, trusts, financial institutions, whatever. Only one class of stock, so we just have common stock. We can't have preferred stock or Class A and Class B and Class C. And all shareholders have to be U.S. citizens or resident aliens. I'm really not sure what that means, but it doesn't matter. So the S corp requirements have been relaxed considerably over the years. I think it used to be you had to have like 25 or fewer shareholders years ago, and they had to be all individuals. It couldn't be anything else. And so for banks, it's interesting that a bank could have layers of S corps. You can have S corps that own S corps that own S corps that owns a bank, and which in effect makes your number of shareholders unlimited. You just have just stacks and stacks of S corporations. I'm sure there's some out there. I haven't done any research to see if there are some small banks that are owned in that way. Anyhow, so why is an S corp? Why is it different from a C corporation? Well, an S corp looks a lot like a partnership. It's taxed a lot like a partnership, but the difference is that it gets the benefit of corporate protection. As far as liability, the corporate veil is there. So why not just have a partnership with an LLC attached? Well, it's somewhat similar to that, but there's another way around all this, is that an S corp, you can be an owner and an employee. So if it's Gary's Guitar Shop Inc. and I'm an S corp, I can take a salary out, and so I can pay myself a salary, whereas a partner I can't. And so that salary then would reduce any of the income that might be subject to SE tax. Also, that if I leave money in the corporation and I've paid tax on that money already through my Schedule K-1 on my 1040 form, I can leave it in the corporation as income previously taxed, take it out of the corporation in the future without paying any additional tax. The IRS dislikes that idea. They think that that's a dividend and should be taxed again. And the S corp rules say no. That's a district that's owner's equity that was left in the corporation that the partner or that the shareholder paid tax on already. They shouldn't have to pay tax twice. Another thing is that if I do that, yeah, I can keep my salary down. I can keep the salary that I pay myself way down out of the corporation, thus limiting my FICA and Medicare payments. So with some businesses, like a regular corporation, the IRS is looking for owners, major shareholders, paying themselves huge wages so they can avoid paying dividends to themselves that would be double taxed. So that's on a regular C corporation that we talked about yesterday. On an S corp, the IRS is looking for owners paying very, very low wages to avoid FICA and Medicare. So that's what the IRS is looking for there. Now, how do you avoid that? Pay yourself a reasonable wage. This is the old rule of pigs getting fed and hogs getting slaughtered. That pay yourself a low wage, but not an outrageously low wage. You know, an outrageously low wage is $1 a month. Well, that's, you know, the IRS isn't that stupid. But let's say you're the chairman or the owner of a corporation, they make a bunch of money and you pay yourself, you know, $85,000. Well, okay, they're not going to argue with that. But if you pay yourself $65,000, nah, probably not. But if you pay yourself $25,000, yeah, they'll start having a problem with that. So it's you have to use your best judgment, pay yourself a low wage, but not an outrageously low wage, and that'll help you limit the FICA and Medicare you have to pay. Then when you the money you leave in the corporation, you can take out later because you've already paid tax on that without paying additional tax on the money you're taking out. Also, like a regular corporation or even a partnership, if you own the building personally, maybe through another LLC, you can pay yourself rent or lease costs, and there is no SE tax on rental income. So that's a popular way of a small business owner to get more cash out of the company, is that the small business owner owns the property personally, rents it to the operation, you know, the partnership or the S corp or the C corp. The C corp pays a pretty healthy rent, and rent is not subject to SE tax. So you save yourself the 15.3% there. All right. So what else happens? Well, there's a Schedule K and a Schedule K1, very similar to a partnership. The income and expenses maintain their character through this pass-through account. This is just like a 1065, and then it acts like a pipe or a conduit is what they call it, that the income and expenses pass right through the owners. So ordinary income is ordinary, dividend income is taxes, dividends, capital gains are taxes, capital gains, that kind of stuff. So just like we did with our 1065 form, it's very, very similar. Some of the lines are different, but very similar. What about S corp losses on page 16? Losses can pass through just like partnership losses, but you're still limited to what your basis is in your ownership of that S corp. You can't continue to deduct losses on your 1040 form if you don't have any skin in the game. You still have to have basis to deduct the losses against, just like a partnership. If anything gets messed up in partnerships and S corps, it's this basis. It's maintaining a basis schedule for each partner or shareholder to make sure they're not eating in or make sure they don't have negative basis for losses. If I were preparing returns professionally as a sole tax preparer, and I have a bunch of people coming to me with partnership and S corp returns, I'd be very careful to make sure that I know what their basis is when they bring it to me. Let's say the S corp has been around for 15 years and they want me to do their tax return all of a sudden. My guess is because their current tax preparer won't let them deduct the losses because they're out of basis. Well, I wouldn't know that unless I go back through as a new preparer, go back through the last 15 years of tax returns to figure out what their basis really is. So yeah, be careful if you have new clients coming to you that have losses, and make sure you contact the previous preparer and ask them for their basis schedule so that you are not caught deducting basis that they shouldn't deduct, because you're going to be the one holding the bag. What typically gets passed through to the shareholder on the K1? Capital gains and losses, 1231 gains and losses, which are similar, but that's 1231 is selling depreciable assets that the corporation owns, and that's like the gain on the recaptured depreciation, that kind of stuff. Dividend income, well, yeah, because it gets taxed at a different rate. Charitable contributions, because that's an itemized deduction. Tax exempt interest, well, it gets passed through to the partner or shareholder, but they don't pay tax on it anyway, but yeah, okay. Most credits, what good does it do a sub S or a partnership to have a tax credit? Nothing. It doesn't do them any good at all, because you don't pay tax at the sub S or the partnership level. It's the shareholders or the partners are who pays the taxes. So if a sub S or a partnership generates a tax credit, it should be passed through to the partner or the shareholder so they can take advantage of the credit. Page 17 and 18, I'm going to skip the top of page 17. Bottom of page 17 and most of page 18 talks about forming the corporation and transferring assets in, and when do you recognize gain or loss, and what do you do if a shareholder transfers in assets that have related liabilities attached to it. So this deals with some circumstances that I'm not saying are unusual, but you only deal with it when you open up the corporation. It's only one time that you bring in new members or new partners. And they give us a good example here, and there's a couple of multiple choice that cover this. So I think I'm gonna wait until we get there in the multiple choices. How about page 19? I'm sorry, skip to page 22. Because I think the pages in between there are the, let me check.
Page 27, maybe?
That's all right, page 27. I think all those other pages relate to a problem. I was just checking to make sure I was right. Talking about corporate accumulations and the accumulated earnings tax. I've only seen this applied a couple of times, but the IRS doesn't like corporations keeping massive amounts of money in their retained earnings, and they use the small dollar amount. It's $250,000 that if you are over that you need to pay 20% of the overage in as an accumulated earnings tax. And all you have to do is show that your cash flow needs you to maintain this reserve. It's a poor argument. Your tax preparer should be able to develop a pretty good argument for you maintaining balances in your capital account. So if let's say that you've got a sub S corporation that really doesn't do much, and really you end up just holding a bunch of money in there. Yeah, the IRS doesn't want you to do that. But this accumulated earnings tax, I mean, I've rarely seen it applied. It's almost always you can tell the IRS that, hey, I need this extra reserve of cash, this extra equity. And when you stop and think about some of the sub S corps of being really large, they're going to have huge reserves way over this 250,000. But this law is out there for the IRS to kind of pile on. If they find an S corp that they don't like, or a corporation that they don't like, and there ends up being a bunch of of reserves in there that, and let's say it's a C corp, and I've got a bunch of money piled up in my C corp that I won't pay out as dividends. You know, and the IRS is mad at me. They might impose this this accumulated earnings tax because I just won't pay out dividends, so I don't have to pay the tax on it. Anyhow, I'm not saying it doesn't exist. I'm not saying it never applies. I just don't see it much. Anyway, personal holding company tax. We talked about personal holding companies the other day, or personal service companies are similar. But usually a personal service corp is formed to actually perform a service, law, accounting, medical, that kind of stuff. A personal holding company is where you really just own a bunch of real estate, and it's almost always rental. And if you have a bunch of money in undistributed earnings, they're going to charge a tax on that. It's like accumulated earnings tax. However, once again, it's pretty easy to explain why you have some undistributed earnings, that you need to preserve the cash. So again, it's coming up with situations where this tax would apply is, I think, beyond our scope. So, and then finally, corporate alternative minimum tax. I really don't want to spend a lot of time on that. The alternative minimum tax rules have changed substantially. There is a multiple choice question on it that we'll skip. But alternative minimum tax prior to 2017, well, prior to tax years beginning on 1/1/18, alternative minimum tax did exist for corporations. It was applied. It wasn't near as messy as it was for personal, but the recent AMT for corporations has been repealed by the Tax Credit and Tax Cut and Jobs Act of 2017. However, the old rules, there may be some opportunity for some corporations to go back and pick up some of the old tax they paid in. Yeah, I really don't want to talk about that. It just kind of muddies the water. So moving forward, so really, the chapter is short. Yeah, there are some things we have to remember with corporate returns, but the big thing is well, we got a balance sheet on page 6 of an 1120. We've got kind of an income statement on page 1. We got a single tax rate. There are some credits. There are some differences between book and tax, but it's not near as complex as individual tax returns are. This is, business returns are easier. And it's because businesses don't vote. There's no reason to make business returns hard. Or to add all sorts of very odd credits or deductions or whatever. Real straightforward. Anyway, page 31. Multiple choice, odds only. Hire one corporation has ordinary taxable income of $50,000 in 2019. We'll use that. Long-term capital loss of $15,000. What's the corporation's tax liability for 2018? Well, in the very first part of the chapter, they talked about the capital gain and loss issues with corporations. You cannot deduct any capital loss against ordinary income. There is no capital gain to offset this loss, so this loss gets carried forward. You can't use it. So we've got $50,000 of taxable income multiplied by 21%. So that should give you letter D, 10,500. The key there is they're trying to point out the fact that we can't use that loss in any way in this year. We have to carry it forward and hope we have some capital gain to offset it next year. Number 3, which of the following statements is false, untrue, regarding corporate capital losses? Again, the general rule is that capital losses can only be used to offset capital gains. Any excess capital loss gets carried forward. So Corporations may deduct $3,000 of net capital loss each year again until the loss is used up. Well, that's untrue. I've got the word no written by it, and which in fact is the correct answer. That's not a true statement. But let's read the other ones. Corporations may carry capital losses back 3 and forward 5 to offset capital gains. Yes, we can do that. We can carry back and forward. It's kind of similar to the old NOL rules. Corporations are not allowed to deduct capital losses against ordinary income. That's also a true statement. Corporations cannot do that. Individuals can. An individual can deduct $3,000 of capital loss against ordinary income and then keep carrying it forward. Letter D, long-term capital losses carried to another year is treated as short-term. It's once you move it to another year, it becomes short-term. But it still doesn't matter. You're offsetting capital gains. So the correct answer for number 3 is letter A. Number 5, Mass Corporation generated a net operating loss of $60,000 in 2019, we'll use, and taxable income of $24,000 in 2020. How much NOL can Mask use in 2020 to reduce taxable income? What they're saying is we've got a net operating loss from a prior year. The carryback feature for net operating losses doesn't exist anymore. It went away. We can only carry a NOL forward. So in the following year, we've got taxable income we can offset. Well, we have some taxable income prior to the NOL deduction that we should be able to offset by our NOL. Now the new rules are we can't deduct it dollar for dollar. We can only deduct up to 80% of this taxable income. So we have to take our $24,000, multiply it by 80%, we get $19,200. Well, we have an NOL carried forward of $60,000, so we can use $19,200 of it. Now, what if the NOL carried forward was $15,000? Well, then we can use $15,000 because the maximum would be $19,200. What about the other almost $40,000 of loss? Well, we carry that forward. Continue. We carry this forward indefinitely. There is no phase out on how long it takes. So we lose the carryback. We can only offset 80% of otherwise taxable income, and the carry forward is indefinite until we use it up. So those are really the changes of the Tax Cut and Jobs Act. Correct answer, letter B. Number 7, which is not a corporate organizational expenditure. Again, like I said yesterday, textbooks always make a big deal out of the organization costs. Okay. Well, the cost of organizational meetings are part of organization costs. Fees paid to state, yeah, that's okay. Accounting fees, yeah. Legal fees, yeah. Letter E, all of the above. And then technically you have to amortize that out over 15 years. Only if it's over $5,000. If it's under $5,000, you can deduct it in the year you do it. Number 9. Which of the following would not appear on an M1?
Gary, what was number 7 again? I'm sorry.
All right, letter E.
Thank you.
E as an easy, all of the above. So we'll get it on an M1 and take a look at it. The M1 is the reconciliation of book income with taxable income, actually line 28 on the front page. So it's not actually taxable income. We could deduct our dividend deduction and that kind of stuff after this line 28. Not sure why they did that. That's a fairly recent change in the tax form itself. Anyway, which does not appear on an M1? Well, an M1 takes book income and then adjusts it. So the very first line is adding back federal tax expense per book. You cannot deduct federal tax expense. So we need to add that back in. So letter A isn't correct because that's in there. What else? Capital excess of capital losses over capital gains. You go, all right, well, we cannot deduct that, so we have to add that back in. Income subject to tax not recorded on books this year. So if I'm trying to think of some good examples on that. If we used the, oh, okay. One thing that might be in there is, let's say we use the allowance method for bad debts. The IRS forces us to use the direct write-off method. So the direct write-off method, we only expense what we actually wrote off. Well, what about if there's a recovery? If there's a recovery, that ends up being income in the future year, and that's not going to be income on your financial statement. So that's an example of a line 4 item. I'll bet you most of those are forgotten or missed. Let's see, expenses recorded on the books this year, book depreciation, charitable contributions if you're if it's over the 10% limit, 50% of meals, letter C, those kind of things. Well, let's take a look at the answer key here, or the responses. Federal income tax expense, well, we know that's line 2. Tax exempt interest is actually line 7. Excess tax over book depreciation shows up in a combination of line 5A and 8A. So the only one that doesn't belong on the M1 is the dividends received deduction, and that's on line 29B, I think, of the front page of the 1120 form. So letter D is the correct answer for number 9. D is in dog. Number 11. Mansfield Incorporated, calendar year corporation, expecting to have a current tax year liability of $100,000. What should they have done? What's the best description? What best describes the tax payments Mansfield should make or should have made to avoid penalty? Now, corporations are supposed to make estimated tax payments, just like partners or individuals. Let's say you're a self-employed individual, you should make estimated tax payments because you don't have anybody withholding for you. So corporations are the same way. There's nobody withholding for them, so they have to make estimated tax payments. They're generally quarterly, so it's like April, June, September, December. It's generally that way. And if you make big enough estimated tax payments, you can avoid any underpayment penalty at the end of the year. Now, what if all of a sudden you think you're going to have a $100,000 tax bill and you haven't done anything all year, and you write a big check on December 29th for $100,000? Yeah, you're still going to have a penalty there. You're supposed to pay as you go. You can't just dump it all in at the end of the year. So the best answer here is letter D. Make quarterly payments totaling $100,000 all during the current year. Now, these are estimated tax payments. Maybe the first payment you make is $20,000 and the next one you make is $30,000 because of how your income is coming in. Because you don't know exactly what your tax bill is going to be, but if you're close, the IRS is all right. They don't care. Now, there are some safe harbors. The old rule is that if you pay at least as much in this year as you had in total tax last year, that's a safe harbor. Now I think the rule is 110%. So if you pay 110% in of last year's total tax, then that might be a safe harbor. There are some exceptions to that, but there are some safe harbor rules for estimated tax payments, both for individual and corporate. Better answer here is a letter D. Letter B and C make no sense at all. You can't make no payments. They'll charge you some pretty good penalties and interest. Making sporadic payments in June and December, yeah, you're avoiding bigger penalties, but they want you to make these payments fairly steady over the year, just like our W-2 withholding is. That's number 11. Number 11 is letter D as in dog. Number 13. Now we're in the sub S questions. That starts with number 12 is where the sub S questions begin. Which of the following items pass through on the Schedule K1? Wages paid, accelerated depreciation. That might be there, but like the wages paid might be there on like box 17, I think, for your qualified business income deduction, but it's not anything we're going to pay tax on. The only thing we would pay tax on or be part of our tax return would be letter C, net long-term capital gains. Advertising expense is ordinary, so that's going to show up. It's not going to get separately passed through. It's going to be as just ordinary income. So letter C is the best answer. C is in cat. Okay, number 15. There's 2 or 3 questions dealing with stock transferring property for stock. Just got this tickle bothering me today. All right. Travis transfers land with a fair value of 125 and a basis of 25 to a corporation in exchange for 100% of the corporation stock. What amount of gain must Travis recognize on the transaction? Well, there's no gain to recognize because there was no sale. It was just an exchange. So this is a 0, letter A. However, he does not get a stepped up basis. You can't do this and step up your basis to 125 and then sell it. The overall basis with regard to gain or loss is still $25,000. So he'll have to recognize the gain when the corporation ultimately sells the property, if ever. Number 17, it would have been nice if they put numbers in here to kind of help us walk us through this. This is explained in the chapter. But anyway, what's the shareholders' basis in stock of a corporation received as the result of a transfer of property to the corporation and as a result of which gain is recognized by the stockholder? Now, if you go back into the chapter and take a look, is when will gain be recognized? And one of them is if I were to contribute property with basis, and let's say it's a piece of land, and I contribute basis of 100,000, the value of the land has gone way up, and so now I have a loan against the house or against the building, just land, I'm sorry, of 125,000, and I transfer both of those into the corporation. Well, in a sense, I've shed myself of $25,000 more debt than basis. And so the IRS says, yeah, you really can't do that without recognizing gain on that. So that's a case where a shareholder does have to recognize gain, is if the debt they transfer over is bigger than the basis transferred over. Now you can see where that might happen if it's like a duplex or something, or a building. Anyway, letter C is the best answer here. Shareholders' basis is equal to the basis of the property transferred minus any liabilities plus the gain. So yeah, so that's it. So what would be the basis in the stock? In this case, it's going to be 0 because if it's the basis minus the debt plus the gain is going to be 0. And I guess in general, I'm sure there's some cases where it's not, but I think in general, and I think we have a short answer question that deals with exactly that case. So letter C, cat.
Hey, Gary?
Yeah.
What was number 15? I'm sorry.
It's all right. A, 0.
Okay, that's what I thought. I thought I better check. Thank you.
No problem. Number 19. Again, this doesn't happen often, but Boyce Industries, a manufacturing corporation, has accumulated earnings of $325,000 and cannot show any reasonable need for the accumulated earnings. They still don't know how that would happen. But anyway, what is Boyce's accumulated earnings tax? Well, there's a $250,000 head start on this. So if we take 325,000 minus 25,000 multiplied by 20%, you end up with $15,000. Letter A. Again, I mean, you can go back and look at how this is calculated, but man, you know, if you guys, any of you guys end up preparing taxes as part of your career and you run up against one of these accumulated earnings tax, be sure to email me because I want to know when it happened. I'm not saying it never does, but
Never seen one?
never seen one. I think, again, this is sort of like an Al Capone thing. You know, he got arrested for tax evasion. They couldn't prove anything else. Well, this is one of those things also like if you get pulled over for speeding and you don't have your seatbelt on, they'll add that in. I think that's kind of what this is, that if they are auditing your return and they find all sorts of stuff they don't like, they might just tag you with this too. Anyway, number 21 is an AMT question. I don't want to go through the details on this. I'll just tell you the answer. Letter D. Letter D, all of the above. AMT's been repealed. There's no reason to spend a lot of time discussing the theory of something that's already gone. Now, if we end up with a different president in November, will they bring AMT back? Yeah, maybe, but it might be in a different form. Okay, so that's the multiple guess. We'll take a deep breath. Get ready for short answer.
You make it sound like this is really, really hard work, Gary. I've just.
I got to tell you, I haven't sat this much for years. You know, I need a more comfortable chair.
Yeah.
I've forgotten how much I stand during the day when I'm teaching face to face, and so this is anyhow. Page 34. Let's do some short answer. What I like about the book, first of all, it's just the right amount of complexity. It's not too hard. It's not too easy. It gives us a good entry level discussion about things. Also, it makes it easy to go back in the book to find things. The questions are listed in order that they're presented in the chapter. We can always go back and find the stuff fairly simply. Number one, Quincy Corporation has taxable income of $485,000 for its calendar tax year. Calculate the corporation's income tax liability for 2019 before tax credits. So this is an easy one. We don't have a graduated tax scale anymore. There are no tax brackets. It's just 21%. So $485,000 multiplied by 21%. And what you get there is $101,850. 485 multiplied by 21%. $101,850. Now, number three, they throw a twist at us. Remember, we cannot deduct capital losses against ordinary income. If we've got some capital losses and no capital gain to offset it, it doesn't affect us in that year. We have to wait till we get capital gains in the future year to offset it. Or we can back up. We can back up. I think with capital losses, we can back up 3 years, go forward 5. I think that's, anyway. For the current tax year, Ilex Corporation has ordinary income of $260,000, short-term capital losses of 60, long-term capital gains of 20. Calculate Ilex Corporation's tax liability for 2018. Okay, so we have ordinary income of 260. What do we do with that, with the long-term capital gain of 20? What do we do with that? Any ideas?
Offset the loss.
We use some of the loss to offset that. So we've got $60,000 of loss, so we can take 20,000 of that loss and completely wipe out that gain. So now the gain is 0. We can't do anything else with the loss but carry it forward. So what does that leave left for us to calculate tax on?
Just the ordinary income.
Just the ordinary income. Yep. So 260 multiplied by 21%.
54,600.
54,600.
How much?
$54,600. Several of them have multiple answers, so number 5 is one of those. What is this? Jack and the Beanstalk here? Physifolia? B5 Physifolia, whatever. Has a gross income from operations of $210,000, operating expenses of $160,000. Corporation also has $30,000 in dividends from publicly traded domestic corporations, in which the ownership percentage was 45%. Calculate the corporation's dividend received deduction for 2018. Now, there are limits to the dividend received deduction. You cannot, but in this case, the limit doesn't apply. So we can just as we do B and C, we'll see how the limit works. In this case, as a 45% owner, and on the second line of the Schedule C, because we're more than a 20% owner here, our dividends received deduction is 65%. So we would take $30,000 and multiply by 65%. And you end up with $19,500. So that's our dividends received deduction in this case. Parts B and C deal with this limit. Now, we didn't talk about the limit, but the limit is really calculated as income before you take into consideration a bunch of stuff, add back the dividends, subtract out the expenses, multiply by 10%, and then compare. Compare to the actual, to the unlimited dividend deduction, and then take the smaller of the two. Unless you're already in a loss. If you're already in a loss, then there is no limit. So that's part B. Assume that instead of 210,000, Physifolia has, maybe it's also Jar Jar Binks, I don't know. But anyway, Physifolia has gross income from operations of $185,000. Calculate the corporation's dividend received deduction for 2018. Well, what happens here is that we've got the 235 gross income from operations, and then what do we have? $30,000 of dividends, and then we subtract out our expenses, and we end up, and the expenses were how much? $160. So we end up with $5,000 of, and so this throws us into what would be an NOL position. And if I can read you the answer key, because they do a better job than I do. It says the taxable income limitation does not apply because the corporation has a net operating loss after deducting taxable income or reducing taxable income by the dividends received deduction. So if I take the $5,000 and subtract out the dividends received deduction, I'm in an NOL position, so there is no limit. So I can still use the 19.5. So this is sort of like this safe zone. Anyway.
So C is 19,500 also?
No, B is.
Oh, okay.
B is in boy. Baker. When we get to CAT is where this limit does apply, and we'll calculate the limit. Assume that instead of 210, Fisafolia Corporation has gross income from operations of 158. Calculate the corporation's dividend received deduction for 2018 or 19. How this works, and the formula is in the chapter, is take the 158,000, add in the dividends we received of 30. So that makes it what, 188,000?
Mhm.
Subtract out the expenses of 160. So then we get 28,000. Multiply that by the 65%, which is line 2 of Schedule C. And we get 18,200. Well, compare that to what the deduction would have been without limit of 19,500. Take the lower one. So we have to take 18,200.
Gary, what did you say? It was 180,000, then we minus the 160? Is that what you
It's
said?
188,000.
Okay,
188. So it's the 158 plus 30 minus 160 multiplied by 65%.
okay, thank you.
You bet. Now, what's the IRS trying to stop here? The IRS is trying to stop people from forming corporations that all they have is dividend income and getting massive deductions for their dividend income. What if I've got a big stock portfolio, Gary Christensen, big stock portfolio, and I have a bunch of my own income, and I'm going to have to pay a massive amount of tax on these dividends? Well, this is saying that it's okay for Gary's Guitar Shop to have some stock in Harley Davidson or Land's End, but Gary has to have other income as well, other earned income. Otherwise, let's say I've got this massive stock portfolio and I form this corporation and have all the stock owned by the corporation, and all I have is dividend income, and I'm deducting massive amounts of my dividend income on my tax return. The IRS says, no, you can't do that. This is for a regular corporation who happens to have some stock ownership in another company. Now, what if you got a vendor? You've got a supplier, and the supplier says, hey, we'll give you a better deal if you become a shareholder. Yeah, that happens. Think about your farmer's co-op. You have to be a member of the co-op to buy stuff from them. It's the same thing. So it's not unusual for a corporation to own some stock into some companies that they might be doing business with. But if all I'm doing is owning a corporation to hold the stock so I get these giant tax deductions, yeah, that's the IRS says, no, yeah, you can't do that. So that's what question 5 is all about. Question 7 is charitable contributions. There is a limit to what you can deduct as a charitable contribution for a corporation, and it's what, 10% of taxable income without taking into consideration the charitable contributions, that kind of stuff. So you can't generate a loss by giving massive amounts of money away. So year 1, we've got a corporation that's a regular C Corp, contributes to, because it doesn't work for an S Corp. Contributions are passed through just like a partnership. $35,000 in cash to a qualified charitable organization during the tax year. Corporation has net operating income of $145,000, net operating income before deducting the charitable contributions and dividends received deduction from the corporation in the amount of $25,000. So what they told us is we have $145,000 of ordinary income, plus we have $25,000 of gross dividends, and they want to know how much can we deduct of that $35,000. Well, that 10% limit is calculated this way in this case. It's $145,000 of the ordinary income, of the ordinary net operating income before contributions, plus the dividends, the full dividends we received, is $170,000. Multiply that by 10% is $17,000. So that's our limit, is 17,000. What do we do with the rest? Well, we carry it forward. So we started with 35. We can deduct 17 in part A. So the rest, the other 18,000, is carried forward. Now in year 2, the same company contributes another $5,000.
What was they?
Part A is 17,000.
17,000.
Year 2, company contributes another $5,000 to charitable organizations. Net operating income of 150,000, and no dividends. So we don't have to mess with that dividend thing. So how do we calculate our limit here? Well, we'll take our $150,000, multiply that by 10%. We get $15,000. Well, so we can deduct, we've got 18,000 carryover from last year, plus the 5,000 we donated this year, and so we can deduct $15,000. Now the question is, which 15 is that? And it works backwards. This is a little different than like NOLs where you go to the back and bring it forward. This works backwards, that you get to deduct the entire $5,000 of this year plus $10,000 of last year. So what's left is $8,000 of last year's contributions moving forward. So contributions work different than NOLs. It goes backwards versus forward. So letter C says, and I read this 3 times trying to figure out what they meant. If there's any carryover of charitable contributions, which we know there are, we've got $8,000 that we carried over. We had 23,000 total, minus the 15 in year 2 gives us $8,000 that we're carrying over. The question is, from what year is that, and what year does it run out? Well, if letter A is year 1, and we say that's the contributions that are still left, the $8,000 that's still left, they'll run out in year 6, because we can only carry them forward for 5 years, and then we're done. So year 6, nothing. So the best answer for letter C is year 6.
And it was 8,000 for B.
Well, no, the limit. What's our deduction for part B is 15. We can deduct 15,000 in part B.
Okay. Right.
That's really $5,000 that we gave in year B, plus $10,000 that we gave in year A. Which leaves $8,000 of year A still left. Okay, this is a perfect opportunity for an Excel table. You'd use an Excel carry forward sheet to keep track of these contributions. Yeah, otherwise, you could just get lost, thinking in circles on some of this stuff. I know I easily get into an analysis loop in my head. Okay, the next one I like, it's asking us to use the forms and think a little bit about the forms. Number 9. We got a corporation that has some book income of 40,000, and included in the book income, and this is just income on your regular financial statement, we have $3,000 of tax exempt interest, $7,000 of book federal income tax expense, $2,000 of non-deductible fines, or you could say non-deductible meals or whatever, non-deductible expense. Also included in book income is $10,000 of dividends. This particular corporation is a 30% owner, so that makes it a 65% dividends received deduction. Using the information in Form 1120, provide the amounts that will go on each line on the form, and they give us these, 6 lines? So if you're looking at an M1, and I'm looking at one, I think I'm looking at one from Aspen that we did yesterday. The M1 is on page 6, and this is taking book income and reconciling it to not taxable income, but tax income before the dividend received deduction, line 28 of page 1. So line 1 of the M1 will be book income, $40,000. If we walk through the M1, line 2, we'll put in our federal income tax expense that we can't deduct. That's $7,000. So we'll add that back in. Line 5, we'll add back in our other stuff, which would go on line C, the second line. Non-deductible fines of $2,000 will go down there on line 5. So we've got 40,000 plus 7 plus 2, so we've got $49,000 on the left side of our M1. On the right side, we've got tax exempt interest of $3,000 on line 7, which is $3,000 on line 9. So if we take line 6 of 49,000 minus line 9 of 3,000, line 10 is going to be $46,000. So we just fill out the M1 form, and line 10 is 46,000. So it's book income plus non-deductible federal tax expense plus non-deductible fines minus non-taxable income gives us our income on line 28 of page 1, 46,000, which happens to be the question line 6 or line C. What is line 1 page 1 line 28? Well, okay, that's equal to line 10 schedule M1, 46,000. What they're asking us to do is understand that these forms and schedules are linked together. So line C is 46,000. Schedule C, line D.
Gary, what was line 10? Did we do that one?
46,000.
For B?
Yep, 46,000. Line A is 40.
Thank you.
Not a problem. Schedule C, line 2A. It's on line 2 because they own more than 20% of stock in this corporation. They own 30%. So we're on line 2. And we were told that we have dividends of $10,000. So line 2A will be $10,000. Do the math. 65% of $10,000 is $6,500. So that's line 2C. So for line D, part A is $10,000, or line 2A is $10,000. Line 2C is $6,500. Then they ask you to just look at the bottom of the form. What goes on line 24? $6,500. Then they say, well, what goes on line 29A or 29B? Well, once I get there we go. 29B is also our special deduction from Schedule C, line 24, where we just were, $6,500. So what does that make line 30? It's 46,000 minus 6,500 will be line 30, 29.5. They're just showing how these forms are linked together.
How much?
Yeah,
Was
what?
How much was that?
39.5.
Okay, I thought you said 49.5, 39.5.
39500.
Thank you.
Not a problem. They just want us to understand that these forms are linked together. They don't just live in a vacuum. All right, number 11. We're an S Corp, ordinary taxable income of 200,000. Now, right away, that should, S Corp sounds like partnership, looks like partnership. Ordinary income goes on the Schedule K1 at the top of the page. They pay dividends to the shareholders. Okay, that's fine. How much taxable income in total must the shareholders of the corporation report on their current year income tax returns? How much taxable income? I'm not sure if I agree with the answer here. Let me see what the answer key shows. Yeah. The answer key shows $200,000 of ordinary income. I wish the S corp. I wish the problem had said the corporation paid or distributed $120,000 to shareholders from income previously taxed. Had they said that, the answer would have been much clearer as $200,000 only. But a sub S corp can pay a dividend as opposed to a distribution of income previously taxed. It can pay a taxable dividend, which is dumb, but it can be done. So I wish that the book had the problem had said there was an additional distribution from income previously taxed of $120,000. What is the total amount of income that will be taxed at the shareholder level? And the answer is 200,000. But if you put 320, I could completely understand that because they call it a dividend instead of a distribution of income previously taxed. Anyway, number 11. Number 13, we've got 2 or 3 parts. And this is dealing with the basis. And this is exactly the situation that I brought up earlier, is where the shareholder contributed basis less than the debt that went with it. Karen's forming a new corporation, transfers land to a corporation in exchange for 100% of the stock of the corporation. Basis in the land is $275. So she must have owned it a long time because she's borrowed $300,000 on it. So it has to have gone up in value. The stock received by Karen has a fair market value of $550. So my guess is the land has a value of $550,000. That's the only way you can say what the stock value has because it's not publicly traded. So the land must be worth $550. She bought it for $275, and she has a loan against it of $300,000. What amount of gain or loss must be recognized by Karen on the transfer? Well, her basis is less than the debt by $25,000. That's the gain she has to recognize. $25,000. Part B says, what's the amount of basis in the corporate stock? Well, it's going to be 0. You have to take the basis, which is $275, plus the gain, which was $25. So that's subtotal is $300. Subtract out the debt of $300, makes her basis in the stock 0. Letter C then, what's the amount of the corporation's basis in the land? It's going to be the basis that was Karen's basis plus the gain she recognized, or $300,000, equal to the debt. So $300,000 is part C. Now, what happens if they sell the property for $550,000? You know, who pays the tax? Karen does. And she's already recognized $25,000 of that gain. Her basis is now $300,000 in the land. So she'll have taxable gain of $200. If she sells it for what, $550? She'll have taxable gain of $250,000. This stuff is complex. It's a mess. It's where, as the tax preparer, you need to maintain a pretty good basis schedule for each of these shareholders. Number 15, we're going to skip. Don't do 15. Because it has to do with AMT, and I don't want to do it. So we're not doing AMT.